Thank you for coming. I have special pleasure and privilege to welcome Maurice Obstfeld, who is here to share with us his perspective very soon after the release of the October issue of World Economic Outlook of the IMF. And he will share with us aspects relating to relevant economic forces which are changing the world, political shocks, what might be the steps to raise growth, stability, etc. We have a very eminent set of discussants as well. I have Shankaracharya and Ajit Ranade on my left, and I have Surjit Bhalla on my right here. So without standing in the way of gaining knowledge from all these four persons, I now give the floor to Maurice. The floor is yours, Maurice.
Thank you very much, Harsha. It's a great pleasure to be here at Brookings India for the first time, and thank you for inviting me. We just completed the annual meetings in Washington and released the WEO, so it's an honor to be here and present some of the results to you. I won't limit myself to the current WEO. I also want to look retrospectively at some of the results we had in the April 2016 WEO, because I think those are going to be relevant to some of what the fund will be talking about. You know, I've been in the job of chief economist at the fund for about a year now, and when I arrived, the concerns that were very prominent for us were China's growth slowdown and ongoing realignment, the effects of lower commodity prices in the global economy, and the Fed's first interest rate increase. Now major concerns are the ongoing effects of China's slowdown and rebalancing commodity prices and the Fed's second interest rate increase, so things have not changed that much. And in fact, the world economy seems to be in a sideways movement at a fairly low overall level of growth, although there are spots of rapid growth, of which India is probably the most prominent. Globally, though, we see weak productivity growth, adverse demographic trends, low demand, and a low natural real rate of interest. Let me just put that up there. And for the world economy as a whole, and particularly for the advanced economies, but I think also for many others, there's a risk of falling into a low growth trap with deflationary pressures. Now, what is new, it was developing a year ago, but I think it's come into full flower, is a nexus of political tensions in the advanced economies that does cast a cloud over the future of growth and global trade integration. And I'm sure when we get to the discussion part of this, we will want to talk about some of these issues. Brexit is a very obvious factor, but the Eurozone, which went through a very serious crisis after 2010, remains in a state of extreme stress, the EU generally, and that's related to refugee problems, among other issues. And these refugee problems are obviously a weight on countries like Jordan, countries in Africa, Lebanon, Turkey. It's not all a European issue. If we look at the US, Europe, there's an increasing tide of anti-trade, anti-immigration rhetoric, which is not leading to anything good. So the fund sees a policy challenge of reinvigorating growth, but also of worrying more than it has in the past about the distribution of the fruits of growth. which certainly seems to be one of the issues driving political unrest. The agenda of increasing growth relies on some aggregate demand support, but also on structural reforms, tax reforms, financial sector reforms, and more recently we've been calling for a comprehensive, consistent, and coordinated approach to addressing problems of growth and inclusiveness. Let me talk first about the numbers that we came out with last week. We do our updates quarterly. We've actually done them quarterly since the global financial crisis. Prior to that, they were semi-annual, and the expectation when we started the quarterly updates was that once the crisis abated, we would go back to semi-annual. And we haven't been able to do that yet. We haven't really gone to a situation of sufficient tranquility and growth. So compared to our July forecasts, global growth has not been revised, and we're expecting 3.1% with purchasing power parity weights for 2016, 3.4% for 2017. What we have revised is the more granular view of how the emerging markets are doing and how the advanced economies are doing. Advanced economies as a group disappointed in 2016, but even there is a lot of heterogeneity. Europe, Japan surprised on the upside slightly. The US surprised strongly on the downside. And so for this group as a whole, there is a downgrade of 2016 expected growth. And you can see the various components here. For the U.S., the slowdown is largely a function of low investment performance, but also very weak inventory performance. There have been 5 straight quarters of negative inventory contributions to growth, and there's hope that this will reverse in the third quarter for the U.S., but not clear yet what will happen there. Consumption has remained strong. So much as has been the case in India as well, we have strong consumption in the U.S., weak investment. As you can see in this middle chart, consumer sentiment is high. The manufacturing PMIs are lately positive, but not in strongly positive territory. And there's a very marked trend in the U.S. of lower productivity growth, which is a longer-term worry.
Josh.
Hey, Josh. How are you? There's also a uptick in news-based measures of volatility, which lately seem very correlated with the electoral polling in the U.S. The euro area is a mixed bag. Britain had a very weak PMI in July, right after the Brexit vote, then a strong one. We can discuss more later if you want about the British economy. We view the long-run prospects as not particularly good. And within the rest of Europe, Germany is doing relatively well. Other countries not so well. And economic sentiment, largely mirrors that. And uncertainty is high. Market-based measures such as the VIX are elevated compared to the height of the euro crisis, both in euro and the UK. News-based measures have really spiked as a result of the referendum, have fallen back somewhat, but my guess is are spiking again as the Prime Minister May's speech to the conservative conference sinks in. What about emerging markets? Their news has been relatively good in 2016, powered in no small part by India, but also by China maintaining its growth. And for next year, we see a uptick in emerging market growth, which is partially due to the fact that Russia and Brazil, two very large weights in our index, are expected to move from negative growth this year to positive growth next year. Sub-Saharan Africa is a very mixed bag, on average negative, but dragged down by the very large commodity exporters such as Nigeria and South Africa. Smaller countries like Ethiopia, which are not resource intensive, are doing relatively well in terms of growth rates. As I said, India is a bright spot, so there's not going to be much news in this chart. Very familiar to you what's been happening. Inflation has come down, ticked up lately. Current account deficit down compared to the earlier part of this decade. Fiscal deficit is coming down and approaching target levels. But there are still structural challenges, and a major weak spot is in terms of corporate debt and the corresponding bank assets, particularly for public sector banks, where there remains a challenge despite a lot of progress in upgrading the bankruptcy and solvency framework. China has been slowing markedly, and in the last days we got the September trade numbers, which were quite weak for China. Since August, which is 2015, roughly when I started my job at the fund, we've had a couple of bouts of market stress over Chinese fears. The last one early in 2016. Are we headed for another one? One can never rule that out. China's slowdown is based in part on moving toward consumption, away from investment, toward services, away from manufacturing. And you can see those trends in the red and blue lines translated into real terms, because investment goods prices have been falling. The trends are less stark, but are still apparent. One noticeable fact, and I'll come back to this when we discuss trade, is that China's share of Asian trade and of global trade has been falling relative to its GDP growth, and this is probably a major factor in driving regional and world events. Whatever is happening in China definitely does not stay in China. And one focus of the WEO, the World Economic Outlook, this time was on China spillovers to the rest of the world. The left-hand chart, thank you, shows trade spillovers of a 1% rise in China's demand after 1 year in various regions, obviously most strong in Asia. But the other conduit that's been very important globally, really since the beginning of this decade, has been China's impact on commodity prices globally. China consumes up to 50% or more of some commodities, notably base metals, and so its rebalancing and slower growth have had a huge effect on the prices. This means that for some countries, there's a trade-off between the direct spillovers of China and the terms of trade effects. For commodity exporters, these reinforce each other, as you can see in the right-hand bar in the last panel. For most countries in Asia, these are offsetting to some degree, because there's a direct trade spillover, but a terms of trade improvement. One focus of concern in markets about China has been the currency regime. What set off the turbulence in August of 2015 was an announcement of a new currency regime, a new way of setting the RMB's exchange rate against the dollar, and an immediate slight devaluation. And you can see in the left-hand chart here exactly, what has been happening. There's been a trend depreciation of the RMB against the dollar, which again initially set off a lot of turbulence, but it seems to have been carried out fairly successfully in terms of not igniting global financial stress. Nonetheless, Chinese reserves have continued to bleed out gradually, and that's been a concern for the authorities. In this chart, you can see, looking at the top of the chart, the decoupling of the Chinese nominal effective exchange rate from that of the dollar that began in August of 2015. It's quite dramatic. China also announced at the end of 2015 that it was moving to a basket system away from, the previous basket system, which was effectively a dollar peg. And what we did in this last chart is to try to estimate the actual weights in the basket, which you can do on daily exchange rate data by just regression analysis. And what you see is that the weight on the dollar was practically 1 in the months leading up to August 2015. And since then, attempts to estimate the weight are not terribly successful in giving any stable pattern. So it's been a fairly discretionary system, and it's hard to pin down what's going on. And one of the messages we've sort of consistently tried to convey is that China needs to move to flexibility, but also to better communication and transparency with markets.
Sorry, Maureen, can I just...
Okay, I'll just, that will be better, thanks. Yes. No, I know it's confusing and, potentially confusing to markets as well. One of the